The Reserve Bank of Australia holds and was less hawkish than it could have been. South Korea's inflation is stronger than expected, and New Zealand's unemployment rate is expected to rise again later today. That's coming up in our 5 Things in 5 Minutes on Wednesday, November the 5th. And then, in our deep dive interview, ANZ Head of Australian Economics Adam Boyton analyses the Reserve Bank of Australia's ability to cut rates again.
I'm still expecting there'll be one more rate cut in this cycle. I still think February is the most likely month.
But first, in 5 and 5 with ANZ, the Reserve Bank of Australia held the cash rate at 3.6% yesterday, as expected. But it took a less hawkish view than it could have of last week's inflation surprise, noting its central forecast contained another rate cut. ANZ Head of Australian Economics Adam Boyton is picking that early next year.
The reasons why I think there's still one more cut in this cycle is I do agree that part of the inflation story that we got the other week was temporary, that's not really where inflation's going to run over the next year. And we're starting to see just a little bit more softness in some of the forward-looking indicators of activity that had suggested that the economy was on track to grow reasonably well next year. They're not yet saying it's not going to, but there's a little bit of an easing in things like the ANZ Indeed job ad series that just takes some of that gloss off where the activity side of the economy looked like it was going.
And we'll have more from Adam in today's deep dive. As at 4 a.m. Sydney Melbourne time, the S&P 500 was down 1% and the Nasdaq down 1.6% after the CEOs of Morgan Stanley and Goldman Sachs warned stock markets could fall 10 to 15% from overvalued levels. The yield on the US 10-year Treasury fell 2 basis points to 4.09%. West Texas oil futures fell 0.6% to $60.70 US a barrel. Gold fell 1% to $3,972 US dollars an ounce. The US dollar index rose 0.3%. The Aussie dollar fell 0.6% to 64.95 US cents, and the Kiwi fell 0.6% to 56.59 US cents. Number 2. Ahead of the RBA decision, the ANZ Roy Morgan Australian Consumer Confidence Survey showed rising inflation expectations and a drop in headline confidence. Here's ANZ economist Maddie Dunk.
The inflation data completely dented hopes of a rate cut in November, so it is likely that a lot of consumers were feeling less optimistic about the rest of the year, given that we weren't likely to see that rate cut come through, and that has since been confirmed.
Number 3. Maddie says there were different moves in confidence based on household type.
We are seeing that consumer confidence is softest amongst renters. We did see a fall amongst those people who were paying off a home loan last week, likely because of the fact that their hopes of a rate cut were somewhat obliterated by that CPI data. And we're seeing that the rental market's still very, very tight right now, particularly in some parts of the country. And that's likely weighing on how those households are feeling right now, as well as the broader economic outlook.
Number 4. South Korea's annual CPI inflation rate was 2.4% in October, above expectations for 2.2%. ANZ economist Crystal Tan says that's the highest it's been since July 2024.
Now, some of these influences are likely to be temporary, so inflation is expected to stabilize near the central bank's 2% target over the coming months. Nevertheless, with inflation remaining above target and Q3 growth exceeding expectations, the Bank of Korea is likely to hold rates steady at its upcoming meeting later this month.
Number 5. New Zealand's third quarter jobs data due today is forecast by ANZ Research to show employment growth of 0.2%, but also a 0.1 percentage point rise in the unemployment rate to 5.3%. Here's ANZ senior economist Miles Workman.
Overall, I think the story that you tell here is labour supply growing a little bit more than labour demand, causing the unemployment rate to rise just that 0.1 percentage point. The good news is, though, we do think that the labour market is close to finding its sort of softest patch before gradually recovering as economic momentum picks up into 2026. So hopefully this is as bad as it gets for the unemployment rate. That's exactly what the Reserve Bank is hoping to engineer.
Miles Workman there. Now, in our deep dive interview, ANZ Head of Australian Economics Adam Boyton analyses why the Reserve Bank of Australia is still on track to cut rates once more early next year.
The tone of the statement was probably a little more dovish or not quite as hawkish on the inflation front as either we or potentially the market had expected. And for me, probably something that drew my eye was the second paragraph in the post-meeting statement, where the bank says and I quote, some of the increase in underlying inflation in the September quarter was due to temporary factors, end quote. Now, I agree with that. We said as much in our weekly on Friday. But what then was interesting was how they added that their central forecast, which is based on a technical assumption of one more rate cut next year, has underlying inflation above 3% for the next few quarters before it settles back at 2.6% in 2027. And putting this assumption of one more rate cut so close to that underlying inflation getting back to 2.6%, I think gave a slightly more dovish tinge, or less hawkish, I should say, than what I was expecting. What the Reserve Bank is saying there is, on our forecasts, even with one more rate cut, we still get really close to the midpoint of the target band by the time we're at the end of our forecast horizon.
So that was on the inflation side. Is there any indication that what's been happening in the labour market has been worrying the Reserve Bank?
There weren't any concerns expressed on the labour market front. The Reserve Bank is still describing the labour market as a little tight, notwithstanding a recent easing, so no concern there. And then when you look at their unemployment rate forecasts, what they have through their forecast horizon is the unemployment rate averaging 4.4% a quarter. So that's telling us a couple of things. They don't expect that it's going to continue rising, and their forecasts assume a little bit that you get a decline back from the 4.5 we got in the most recent read. So no concern about the labour market yet. But if we were to get a further move higher in the unemployment rate and some ongoing weakness in those key forward-looking labour market indicators like the ANZ Indeed job ad survey, then I think the Reserve Bank would start to get worried, but they're not there yet.
Did the RBA themselves give any indication of where the risks lie for both inflation and the labour market?
What the Reserve Bank said in their post-meeting statement was that risks are seen in both directions to the inflation and employment outlook. So inflation could be higher, it could be lower than we think. The unemployment rate could be higher or could be lower. And it's that general sense of, look, the risks are skewed evenly, but in all directions, which then I think comes back to this point of caution, and that the Reserve Bank Board are going to be cautious for the next little while. They're going to want to see some more data to inform a view about which one of these factors, higher unemployment or higher inflation, is the higher inflation just temporary? Is it going to stick around a bit? Is the unemployment rate going to stop rising? They're all the questions that the board is going to want more data to provide answers for. Of course, the forecasts in the Statement of Monetary Policy say we expect the unemployment rate to broadly go sideways. We think this September quarter inflation print was a one-off and inflation will moderate and get back toward the midpoint of the target band by the time we get to the end of 2027. But the risks around all of that are in both directions.
So earlier in the year, the RBA was putting quite a focus on the global situation. Is that still something they're looking at?
No, they're still talking about it. It's still a potential risk. But in an environment where domestically you've got the labour market saying maybe we should cut rates some more, you've got inflation saying, hold on, no, let's not do that. I think it's that the fact that the domestic story isn't as clear as it was is the central sort of focus, I think, for the RBA's board, or the Monetary Policy Board, I should say. And those things are a bit more front and centre now. The other thing I'd say on the global environment is some of the worst case scenarios, of course, from earlier in the year haven't come to pass. The global economy is doing reasonably well, and so that's receded into the background a bit, while this question of will it be the unemployment rate or inflation that dominate the discussion domestically over the period ahead.
And just finally, your pick for the rate cut from here. We're still looking at early next year?
I'm still expecting there'll be one more rate cut in this cycle. I still think February is the most likely month. There's a risk that it does occur a little bit later in May and that the Reserve Bank Board need a little bit more data to convince them that cutting is the right thing to do.
Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, November the 5th. Catch you tomorrow with what New Zealand's jobs data today could mean for the Reserve Bank of New Zealand's rate cut path. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.